Hello everyone, welcome back to our discussion of Chapter 4 and long-term assets. We finished up those tangible assets in the first installment of this podcast, and here we are talking about intangible assets in Part 2. So, first of all, a little bit about what intangible assets are. First of all, they have no physical substance. They're not like a building or equipment or something like that. They're more of a right, some type of a valuable future benefit that helps the company earn revenues, but you couldn't actually touch it or feel it, sort of thing. So some examples: patents. So patents involve the right, you invented something, came up with a formula, and patent protects you against other people using your idea to make money. So you have the exclusive right for a set amount of time. In the case of a patent, it's 20 years, that you can have the exclusive right to make money from that invention. And once the 20 years is up, then anybody can copy it. Okay, so it does have that limited legal life. Trademarks, the kinds of things you see on billboards and are used in advertising that tell you the company, about the company, also are protected. Licenses, that sort of thing. So copyrights on creative works are similar to patents, except they have a much longer life under the law. So now that we have some idea of what we're talking about, these intangible assets, if they have a useful life, then we depreciate. The term that is used in the rules is amortize rather than depreciate, but it means exactly the same thing. The assets, we don't usually have more than one way to do it. We almost always use straight line. So there's no need to remember double declining balance or any of those. And using the useful life as we learned earlier. Now, there's a little bit of differential between what the legal life. So under patent law, if you get a patent, it will last for 20 years. If you have a copyright on a creative work, on a song or something like that, a piece of art, that lasts 70 years after the person who created its death. So there's some legal things. Trademarks, on the other hand, have no legal life. They will last forever as long as the company is using them. So often the law will say that you have this exclusive right for a certain period of time. Now, that may not really be realistic, meaning patents and technology changes so quickly that many times you may have a particular formula or an invention that is going to be obsolete much faster than 20 years. And therefore it will have zero value. So at that point, there may be a different useful life. We may still have to make a judgment as to the useful life that is separate from what the legal life is. All right? So that's just to keep that in mind. Historic cost paid for the asset. Again, just like regular tangible assets, we record what we paid for this. We do have some differences in this regard, but generally, if you buy it from someone else, then you're going to record on your balance sheet the cost you paid for it. The biggest difference from tangible assets is that legal fees to protect that right can be added to the cost. So unlike a diesel engine or something where you might do an overhaul and make it last longer and do a betterment, if it's a patent or a trademark or some legal right, you may have to go to court to sue or fight someone who is infringing on that. And when you are successful at that, that protection of the right can add to the cost. It's kind of like an improvement to that asset. Now, here's where we run into some differences, especially with intangible assets and how they're accounted for. You can either make them internally or you can purchase them from others, just like any asset. You can either build a building yourself or you can buy it already built. Okay? You can do the research and develop a patent, or you can buy the patent from someone else, the inventor of the product. Okay? Now, here's where we run into some interesting rules under US GAAP. Any cost spent on research and development must be an expense, not an asset. So you do millions of dollars in research on a new drug if you're a drug company. None of that gets included in the cost of the patent on the drug. As you pay all the scientists, as you pay for all the expenses of lab space and all that kind of stuff, that all is an expense. None of that research is part of the cost of patent. So when you finally get the patent, the only cost that you'll probably have is the legal fees to file the patent with your attorney. So you could have spent millions and millions of dollars developing a new drug, but the cost of the patent on that drug, if it's internal, will actually be listed on your balance sheet for maybe $20,000 or $30,000, because all the other costs would have been an expense immediately and not an asset. That's the rule. The GAAP is very conservative, and it says when you spent that money, you didn't know if it was going to develop into something you could use or not, and so therefore it had to be expense. They didn't know if there was a future benefit, and we're not going to go back and change it after the fact. Now, contrast that to if you buy a patent from another drug company. So you go to the inventor of a drug, a biotech company who has 5 or 6 scientists, and they've developed a promising new drug. They've got a patent on it. When we buy that from them, because they can't manufacture the drug, they need our help to do that, so they sell us the patent. We would spend we will buy it for maybe millions of dollars. If it's a promising drug, we may spend billions of dollars to buy that and buy that right, that patent to be the exclusive one to make money on that drug. That billions of dollars would be on the balance sheet and would be used up over time as amortized or depreciated over its useful life. That's a very different amount than if you would have spent all those millions of dollars internally to develop the patent. So there's kind of a difference in the accounting rules as to how we treat things that we buy from others, intangible assets, or we develop ourselves. But that's just what we have to deal with in the rules. Now, kind of the last idea under when we talk about intangible assets is the concept of goodwill. It is not the stuff we donate to replace gold clothes or things like that. It comes about when we buy another company. So when we buy, one company purchases a stock of another company. When we buy that, the purchase company is called the subsidiary. The buying company is called the parent. The amount of the purchase in cash is usually given. You usually know what that is. We credit cash for the entire cash that we pay for the company. Then when we record, we're recording this acquisition of the business. We're going to debit each of the assets we acquire with the subsidiary. So if the subsidiary has inventory, we're going to debit the parent company's inventory to show that we now own that inventory. Same thing with receivables, same thing with equipment, same thing with patents, with trademarks, any other assets. And each of those is going to be recorded at its fair value, what it's actually worth. All right? Which, in essence, is what we're paying for. What we're paying fair value. So, some of those values will have to be estimated, especially intangible assets. If we pay more than the value of the assets that we get, that's called goodwill. That's the idea that we buy this company as a whole because the whole company is worth more than the individual assets. If you added up all the assets that the company owned and subtracted the liabilities, the company's worth more than that because people recognize the name, because it has a reputation, because it has good employees, well-trained management, whatever. Any of those could contribute to this idea that this company is worth more, and that's why we're going to have to pay more than what the individual assets are worth. So, an example. Big company or the parent buys stock of little company, the subsidiary, for $5 million. Little has property worth $1 million, receivables worth $1 million, inventory worth $1 million, a patent worth $1 million. So we will, if we're big, the parent, we will credit cash for the $5 million, we will debit property for $1 million, receivables for $1 million, inventory for $1 million, and patent for $1 million. Because that's what we paid for them, that's what they're worth. We don't care what little paid for them. That's what they're worth to us, big company, the parent. However, that's $4 million. Debit, 1 to property, 1 to receivables, 1 to inventory, 1 to patent. They're still missing $1 million. We paid $5. They have assets worth $4. If there were liabilities that little had, we would credit our liabilities to show that we not only get the company's assets, we also get their liabilities. But no liabilities in this case, so we debit another $1 million to goodwill. That's where the goodwill comes from. Only time we record goodwill is when it is acquired and when we buy the entire company. It, under U.S. GAAP, has no useful life. So it does not get depreciated. Any intangible asset that we can establish useful life, for instance, trademarks, same idea. Trademarks last forever, so technically there's no useful life. If we decide there's a useful life because we were only going to plan on using it for 5 years anyway, then we would use that 5 years. But legally, there is no end to a trademark. Same thing with goodwill. With any intangible asset that has no useful life, or we cannot determine what the useful life is, we don't do depreciation. We simply test it for impairment to see if the value has decreased. And we do that on an annual basis. Now, how you do that is quite complex and is talked about in much more advanced accounting classes. But for our purposes, we just need to know that you're not going to depreciate it. You're simply going to test for impairment. So to look at the journal entry for this purchase, you'll see that we debit, and again, emphasizing that we use the fair value of each of these assets when we debit it. This would be the debit. This is the journal entry that big would make. Little is going to go away, right? All their stock is going to now be owned by big or the parent. And so technically as a company, little is going to disappear. But for big, we're just going to put $1 million in here so that this will balance, right? So that all the total of the debits will equal the total of credits. And the only number that would make that work would be $1 million to Goodwill. So each one of these then would go on our parent or big company's balance sheet now and added to whatever other property, inventory, receivables they own, and so forth. So that is how we get Goodwill into our company.